Hi everybody, this is Alan Ellman, the Blue Collar Investor, with today's option selling question of the day. Today's question comes from Karl. Alan, I bought FIVE for $76.19 on May 17th and sold the June 75 call option for $2.86. As expiration is approaching, the stock moved all the way up to 102.09, and I'm considering rolling out and up to the 105 strike. Is this a good strike to consider, as I am still bullish on the stock but concerned about the paid up risk of buying back the option, $27.50? Thank you, Karl. Okay, so Karl had a successful trade. He sold an in-the-money strike. The price of the stock is expiring higher than the strike price. So he generated the highest possible returns he can get for that initial trade. And now the question is, does rolling out and up make sense? Okay, let's first review Karl's trade. On May 17th, Karl bought 100 shares of FIVE at $76.19 and then sold the June 75 in the money strike at $2.86. So we know right off the bat that the $2.86 is not part of the initial time value return. We'll break that down in the next slide. Then on June 14th, the day prior to contract expiration, FIVE was trading all the way up to 102.09, well above the 75 strike, and the cost to close that 75 call to buy it back was $27.50. That's the risk that Karl was alluding to in his question. Now, of that $27.50, $27.09 is intrinsic value. That's the amount that the 75 strike is lower than current market value of 102.09. The remaining 41 cents is the time value cost to close. Now, on that date of June 14th, the July 105 out of the money next month strike would generate a premium of $2.80. So that's the dilemma that Karl has. Do I roll out and up? Now, let's have a look at how the initial trade was structured. And for that, we're going to use the multiple tab of the Ellman Calculator. And most of you are familiar with that. On the left side are the blue cells. You could see we put in the ticker symbol of the stock. The price was $76.19. The strike was 75, and the premium that we generated originally was $2.86. The expiration was June 15. Now the white cells become populated, and the first thing we see is intrinsic value of 119. That's the difference between the strike price of 75 and the price of FIVE when Karl first entered the trade, which was $76.19. So when you're figuring out your return on your option or your RU, you have to deduct that 119 from the total premium of 286. Of course, the calculator does all that for us. Break-even column is simply the price of the stock minus the entire premium. Now, the actual time value return on our option or RU, that's what the 119 deducted from the 286 is 2.2%. So if we're setting up a time value return goal of 2 to 4%, which is what I use in my account, then this would meet that standard. Okay, and it may vary in your account. It could be more or less, but 2.2% is what you're getting. You have to make sure that that meets your goal. Now, upside potential, of course, when you sell an in-the-money strike, there is no upside because we're agreeing to sell it at a lower price than current market value. But the downside protection represents an insurance policy, albeit a little one in this case, of 1.6%. So that means that FIVE can decline in value by 1.6% by contract expiration, and we still will have realized that 2.2% initial time value return. In other words, if it stays above the 75 strike. All right, so that's where we were initially when Karl structured this trade. Looks like a pretty good trade to get involved with. Now we already know that the price went to the moon after that. So let's have a look again at the What Now tab of the Ellman Calculator. The previous was the Multiple tab. Now we'll go to the What Now tab and see what happens if we buy back that call option for $27.50 and then sell the next month's highest strike, 105 strike, at $2.80. So here we have the calculation results from the What Now tab, and you could see in the yellow row over there, what if I roll out? Well, the reason we didn't get into rolling out is you could see highlighted in yellow on the right side, it's only because there'd be like a 0.26% return, time value return by rolling out. Even though you have huge downside protection of 26%, it still does not meet our goal. I mean, we're not gonna be doing this for a return of 1/5 of 1% or 1/4 of 1%. Okay, so now what do we have if we roll out and up? Now the cost to buy back the 75 call, you could see highlighted in the brown rows, was $27.50. That was the cost to buy back the 75 strike in the previous month. Now the blue arrows point to the two possible situations here. One without upside potential and the other one with upside potential. Since we're rolling out to the 105 strike and the current market value is 102.09, there's an opportunity for the share price to go up to the 105 strike, and we will participate in that share appreciation. So we have with and without share appreciation as part of the calculations here. So when we take our option loss, because we're spending $27.50, getting back $2.80, and add in the increase in share value, because before we roll out and up, our shares can only be worth 75, no more. By taking away that 75 strike and rolling out and up to the 105 strike, our shares are now worth current market value of 102.09. And so we have to calculate that in, and the calculator tells us that we have, without upside, a 3.14% 1 month return. Not too bad. With upside, if the price of the stock moves from 102.09 up to the 105 strike or beyond, that will give us a total return of 6.96% over the next 1 month. So you can see here that by rolling out and up, we have some pretty nice returns. Now, of course, all of this is contingent on the price of the stock either remaining the same or going higher. So we must be bullish on the stock and, of course, on the overall market to take advantage of rolling out and up. It is a bullish exit strategy. Now, some people might say, but gee, I don't want to spend $27.50 per share. It's almost $3,000 per contract to buy back the option. That's crazy. Well, let's assume for a moment that we allow assignment. Or let's assume for a moment that we never even owned this stock. It was never in our portfolio. Now here we come up to the next month. We take a look at FIVE. We see it has very strong technicals. We see it as an elite fundamental performer. And we see it returns options that meets our goal. Well, then we would just go ahead and buy it at market. Well, let's say the price remained on Monday at 102.09. Okay, we buy it at 102.09. Remember, we only paid 76 and change for the stock a month ago. All right, so we're paying that extra money now, and that would have been in the form of intrinsic value if we bought back the previous option. So most of the money we spent on buying back a deep in the money call option as expiration is approaching is in the form of intrinsic value, which in essence will raise the value of our shares, except for the time value component. All right, well, we buy it at 102.09. We sell the 105 strike for $2.80. Let's assume everything stayed the same on Monday. And that will give us an initial return of 2.7%, pretty good, and upside potential of 2.9%. And that's also pretty good. So overall, we have an opportunity of a 5.6% 1 month return if we just entered the trade brand new the following week. And that's the reason why, if we're buying back an option at a big cost, it's almost the same thing as never having owned the stock, but spending that extra money the following week to buy it because it's appreciated in value. So from a philosophical standpoint, what you're doing is you're paying for the price of the stock now in the form of intrinsic value when you buy back that call option. All right, so let's summarize this. Rolling out and up is absolutely a bullish exit strategy. You should not use it unless you are bullish on both the stock and the overall market. All right, less bullish exit strategy would just be rolling out, but in this particular case, as you saw before, the return was only 0.26% and wouldn't meet our goals. So if we were going to either roll out or or just allow assignment, I would allow assignment. Who cares? There are plenty other stocks out there. Now the cost to close, and this is important for deep in the money strikes, is mostly intrinsic value and is compensated for by the increase in share value that was once restricted by the previous strike price. Time value returns, upside potential, downside protection also must factor into our decisions when we're rolling an option. I mean, in this particular case with the stock at 102.09, we rolled out and up to the 105 strike. That was out of the money. But what if we rolled out and up to the 100 strike? It's out next month. It's up. It went from 75 to 100, but it's in the money, 100, compared to current market value of 102.09. So when you're rolling out, you're always rolling out to an in the money strike. But when you're rolling out and up, it could be to in the money, at the money, or out of the money. Okay, so you have to take a look and see which is the most appropriate. Make sure it meets your goal. If you can roll out and up to an in the money strike, it'll give you a little extra protection to the downside. And if you roll out and up to an out of the money strike, it'll give you an opportunity to add on another component, a second income stream in the form of share appreciation from current market value up to the new strike price. So there you have it. First off, I want to thank Karl for sharing his trades with us, and congratulations on a successful trade, Karl. And of course, I want to thank everybody out there for taking the time to watch this video. Hope you enjoyed it, and most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.